at a certain extent, it's a global steel sector, and we have overcapacity globally. If let's say, and the European producers, they are also net exporters in many cases. If these mills going out of business and they're least efficient on the global cost curve, it's positive for Russian steel mills at a certain extent because they can export more on the European market at more competitive price. So that idling of capacity is a necessary thing to balance the market and to bring a supply-demand balance to equilibrium and to support prices. So in the long run, definitely, yes, it's going to balance the market and to support prices. That's what we call supply response. And that's happening. Until recently, actually, probably until 2008, even, of course, before liquidity crunch, the steel price has been largely supported and driven up by iron ore and coking coal prices. 70% of the cost base of non-integrated producers, that's iron ore and coking coal. And it's been driven by a huge demand from China and so-called commodity supercycle. What we've seen over the last probably a couple of years, that's a significant downturn in iron ore and coking coal prices. It's a big question where we are going to see the price levels of major bulk commodities. If let's say, if iron ore and coking coal prices, iron ore prices stabilize at current level, and coking coal prices probably recover 15 to 20%, and simultaneously we see idling of excessive capacity, steel prices may be supported and move up closer to the second quarter next year. However, if we are going to see significant downturn and further collapse or what we call deflationary scenario in steelmaking raw materials, in other words, drop of iron ore and coking coal prices, it may lead steel prices further down.